us at the moment. We've got Bob Iaccino, founder and president of TraderOutlook. He trades across every asset class, and he's coming to us live from the CME Group in Chicago. Bob, great to have you here on Street Smart. Let me connect the dots, or ask you to connect the dots for us, actually. We heard Nick there talking a little bit about high-yield debt starting to look attractive. What looks attractive to you right now? And when we take a look at the action we saw into the closing bell, how do you interpret that? I mean, stocks turned around pretty quickly. Not a big movement, though, really, in treasuries. We're still seeing the 10-year yield fairly low at the moment, around 1.83%. But what about the other asset classes? Is there something now that you'd go in and buy?
Well, let me take a step back, if I could, and sort of connect some of what Nick and the previous guest from the NYSE was saying. You're looking at a classic short covering rally right now. These big down days do not get covered by massive institutional buyers like Nick at Fort Washington Advisors. They don't dip their toe in the water on a low off of a headline from the EU. We've had several headlines from the EU. This one is one of the less memorable ones that I can think of, but still trading is so short in duration and so quick to the trigger that positions get covered, and that's what's happening here. Now, Nick also touched on the way that they reacted as a large institution in 2009 when they started dipping their toe in the water. This is 2008, not from a perspective of the massive economic failures we may see, but from a perspective of the way that things are trading. Dollar index goes above and gets stronger above 77. Even gold fails a little bit. When the dollar starts to weaken, more liquidity, stocks will be supported, institutions will buy the high-yield corporates, and the rally can come from there. I look at this as being similar to 2008 as a good thing, as if we can buy banking stocks like J.P. Morgan and dip our toe into the water into that type of a situation, buy gold to possibly hedge that, buy a few commodities, and get back some of these losses people have seen.
Bob, for the average investor, you buy it and never look again, or just don't open the statement until a year from now, because it's easy to get caught up in sort of the daily gyrations and feel like you're better off on the sidelines?
Well, look, the average investor isn't in the market right now, and that's part of the problem that we have. What I feel that people need to do is they need to learn what trading is. They need to learn what a closing rally like this actually is. It's not people like Nick from Fort Washington coming in and putting $8 billion to work. Okay, they do things a little bit differently. And they need to understand that these types of gyrations, it is noise. But there are crises. If your duration is 2 years, I'd worry a little. If your duration is 10, I wouldn't worry so much. Short term, there's a rally coming in the S&P. There's divergence in the technicals. We had a lower low, but yet weaker bearish momentum on some of my indicators. So there is a rally coming. I talked to your producer about it. I think the rally starts today, but then you have to be careful again. The market tends to rally in 3 to 5 day spurts and then collapse in 2 day spurts. That scares investors.
Hey, you know, Nick, it occurs to me as I listen to both you and Bob talking about volatility in stocks and almost more inclined to go into bonds. You mentioned you're looking at some of the high-grade bonds. What kind of yields are you finding on these bonds? And are these bonds that people can buy at home, guys who are watching?
Yes, you know, I would say, you know, give you an illustration, at the worst part of the 08-09 period, you were getting junk bond yields, and I'm talking, you know, not lowest quality. You were getting high teens, 20% or so. You're not there today, but you had gotten down to yields 7% or so. You're probably now talking, you know, 8-9% in that area, depending on the quality. And again, I'm emphasizing we're focusing on more in the B spaces, double B or single B, not in the lower rated C space, which is more equity-like.
All right, thanks so much to you both. We got to leave it there. Nick, good to see you again. That was Nick Sargent, Chief Investment Officer at Fort Washington Investment Advisors. We also had Bob Iaccino, founder and president of TraderOutlook, joining us, of course, from the CME Group in Chicago.